Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber's report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term confidence and sentiment. This month I'd like to update you on our thinking regarding the stealth sinking size of the S&P 500 stock pool and what it means for you in your investment decisions. As such, I would therefore like to cover the following subjects outlined here. The float is the number of shares actually available for trading. Float is calculated by subtracting closely held shares owned by insiders, employees, the company's employee stock ownership plan, or other major long-term shareholders from the total shares outstanding. This can be difficult to determine and therefore requires and depends on definitions. The public is unaware of how this is determined and generally have to pay service providers for the specific information on how it's calculated. When a firm reduces the number of shares available to trade, then so-called float manipulation can occur. This is well documented, and interestingly, one detailed report by the Harvard Business School entitled Float Manipulation and Stock Prices spelled this out in detail in 2005. We'll come back to that 2005 date in a moment. They proved with a study of 2,000 Japanese firms that the following occurs when the stock float is reduced, and I think most of this is common sense. 1. The price of the stock is often driven up, if not always driven up. 2. Stock prices are raised significantly when there are differing opinions about the values of the shares. When risk-adverse investors have differences of opinion and are short sale constrained, reductions in the float freeze out pessimistic investors, pushing up prices, vis-a-vis when people believe the market is too overpriced and should be shorted. When the float is released, that is brought back into the public domain for trading, typically it falls. In actual fact, this is part of the S&P 500's dirty little secrets and how quiet changes in the methodologies have fundamentally transformed that index. 3 examples of how this S&P 500 index methodology has been quietly but substantially changed over the past 16 years are listed here, and there are more. In 2002, there was a removal of all foreign companies from the index. In 2005, we had a float-adjusted market capitalization change. There's that 2005 date, coincidentally. In 2014, we had the inclusion of mortgage REITs. All are interesting changes, but we only have time to focus on just the one today. But let me tell you, the other 2 are also just as interesting. Since 2005, the S&P 500 has been float-weighted. That is, it is a float-adjusted market capitalization index. What does that mean? When the individual market cap is calculated for a company, part of the index, only the outstanding shares that can be freely traded without any restrictions are taken into account. As we previously mentioned, not all outstanding shares of a company are available for common investors to trade. For example, shares held by individuals with access to insider information are under special regulation. Another very interesting adjustment that could change the weighting of a stock for big holders and then be fluidly changed back when the circumstances change because they assert they no longer have insider information at that point in time. To put all this into perspective, the float-adjusted value of the S&P 500 index in 2016 was around $1 trillion smaller than the unadjusted total capitalization. A research report from Horizon Kinetics uses Microsoft as an illustration. Had these rules been in effect during the 1990s, what would have it done for the index fund for investors? And I'm dating this, not since this was put into place, But what would have happened in that case? When added to the S&P 500, the share price was around $2.41. At January 1999, when the stock was $44.75, insiders still owned 31% of the shares. By September 1999, near the peak of the great technology or dot-com bubble, when the shares were $47.50, and when Microsoft's weight in the S&P 500 exceeded 4%, insider ownership had been reduced to 26%. And by early 2000, the very threshold of the collapse of that bubble, when the stock was $35, insider ownership had dropped to 19%. 13 years later, the shares were lower than that. Whether by fortune or perception, insiders were dramatically reducing their holdings going into a decade-plus period of decline and stagnation. What did outsiders do? Had the float-adjusted index weighting method been in place at the time as insiders sold such that the float increased, the index rules would have increased Microsoft's weighting, and mutual funds and other index investors would have been buying more of what the insiders were selling. So we have to understand the flip, the opposite sides of what's good for the holders, what's good for the markets. This slide shows the actual mechanics that go into deciding which shareholders have control of the company are included as being removed from the float. And you can see it's a pretty extensive list of different holders. Additionally, the following holders' shares are generally considered part of the control blocks. It starts to look like who is not considered part of the control. I know a lot of you hated this back in school, but it is important to revisit the well-proven supply-demand curve. When you have restricted supply or supply is reduced, it moves the S, the supply curve, to the left, as the arrow here shows. This means price would be expected to rise with the same amount of demand. We'll soon show you exactly how reduced supply occurs through private equity buybacks and foreign buying with regards to that float-adjusted market capitalization weighting. Though I haven't got time today to talk about it, a dramatic reduction in IPOs, likely associated with the predatory Sarbanes-Oxley legislation of this era when these changes were being made, fewer secondary stock offerings as a result of corporations using bond debt instead, and increased mergers and acquisitions over the last decade have also additionally contributed to a shrinking stock float. So far, our supply-demand has been about supply, but demand has certainly been contributing, since we just experienced an unprecedented bull market since the advent of also unprecedented monetary policy associated with QE and ZIRP. They knew this was going to occur. Cheaper margin and euphoric investor demand growth have no doubt pushed on demand, but critically important is the explosion in passive ETF buying. These ETFs are dominated by holdings associated with the major float-adjusted market capitalization indexes. They feed on themselves, pushing the demand curve to the right, also pushing prices up. I think you can see what's going on here. Don't you wish you were taking your Macroeconomics 101 course today? You could really challenge your prof. Unless he, of course, is out trading the market with your inflated tuition debt. Sorry, I digress here. In a previous video where I outlined a reflexive cycle we have created, I showed this slide regarding the distortions which have been driving the markets. Buybacks are up $3.8 trillion since 2009, while private equity of the top 4 private equity firms are now $1 trillion in assets. We have 4 phenomena now working to capitalize on this stock float opportunity, whether by happenstance or by strategy. I think it is actually the latter, because of the dramatic growth in corporate debt, degree of leverage these players are willing and driven to assume, and the dramatic growth in zombie corporations, which I'm also addressing in other subscriber videos for you. Just look at this chart. We all talk about the government debt and household debt, and it is massive, but it is relatively contained compared to global corporate debt shown here in red. Let's just take a quick look at private equity first. I mentioned the top 4 U.S. private equity firms now have over $1 trillion in assets alone. This is up dramatically in the last 10 years. Shown here in tan color, you can see that the growth is going exponentially. Investors are clamoring to get in. What is their strategy? One thing we know is they don't start new companies, but rather take over existing public companies or control of them, which means there's still outstanding shares going on, but not theirs because they're part of the control block. Leverage them up with debt, merger them, or other strategies that are stock price oriented. Recall that their shares, as I said, are removed from the float, of course, until they are sold. Meanwhile, as they hold them and their stock goes up, they have more collateral which to increase total buying leverage. Must be a wonderful ride for them. We've also talked almost endlessly over the last 6 to 7 years about the degree of stock buybacks occurring. It is now well above 3.8 trillion shown here and climbing. The corporate sector has been the main and dominant buyer of U.S. equities since the market low. Nothing even comes close. This market has been overbought for so long that few believe in it any longer and have long ago exited, but price-insensitive corporations didn't. They keep buying. Why? They aren't stupid and clearly must have some sort of strategy at play here. U.S. corporate debt alone is now over 45% of U.S. GDP. How long can it be sustained? Their cash flows are already in peril, as well as their credit ratings because of the size of the debt they've already taken on. Clearly, the disconnect between their debt and productive capital stock doesn't bode well for the future. It is extremely troubling when consumers and corporations both have extreme levels of debt because they both depend on each other, either for employment or profits. The problem of debt payment levels versus cash flow and profits is becoming a global issue. Whether zombie corporations or challenge firms, the numbers are once again worrying. We will have more about this again in an upcoming Under the Lens subscriber video. The third phenomena is the amount of foreign direct investment that has been flowing to the U.S. The U.S. averaged $24.3 trillion from 1994 until last year. It reached an all-time high of $47.5 trillion in the fourth quarter of 2014 as the post-Great Financial Crisis U.S. stock market rally began to accelerate with massive central bank liquidity injections. The fourth phenomena is the growth in ETFs. Global ETF assets could reach $7.6 trillion by the end of 2020. This is equivalent to a compound average growth rate of 18%, of which 13 to 14 will come from net new inflows. This will dramatically push that demand curve to the right and prices also up. All else staying the same, of course. But that may be the issue. Of course, all else may not stay the same. Our look has been in the rearview mirror in this discussion. This ETF dynamo could easily reverse and adjust a highly over-leveraged financial system. Too many sellers with a mouse clip can do a lot of damage to an ETF basket and dramatically and almost instantaneously change the supply dynamic to massive oversupply. I will leave it to you to decide what lies ahead. The only thing I am certain about is they'll print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. I'd like to take a moment as a reminder, do not trade from these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2018 be an outstanding investment year for you and your family, and I thank you for listening.